In simplest terms, a lien is a legal claim against someone's property. This claim is used as security for a debt or obligation. Think of it like this. If someone owes money and doesn't pay, a lien allows the creditor to potentially force the sale of the property to collect the debt. Liens are critical in real estate because they affect property ownership, transfer, and value. Imagine buying a house without knowing about a previous owner's unpaid debts. Suddenly, you might find yourself responsible for those debts or even risk losing the property. Understanding liens is crucial for both buyers and sellers to make informed decisions and protect their investments. Liens can significantly impact real estate transactions. They can delay or even prevent a sale until cleared. For example, if a contractor places a mechanic's lien on a property for unpaid work, the title cannot be transferred free and clear until the debt is settled. This makes understanding liens a fundamental aspect of real estate law. Liens are categorized into three main types: statutory, voluntary, and involuntary. Each type is determined by how the lien is created and enforced. Understanding these distinctions is crucial in comprehending the implications of each lien. Statutory liens are created by law, meaning they automatically exist when certain conditions are met. A common example is a property tax lien, which is placed on a property when the owner fails to pay their property taxes. These liens are put in place to ensure the government can collect its due revenue. Voluntary liens, as the name suggests, are entered into willingly by the property owner. The most common type is a mortgage. When you take out a mortgage, you voluntarily agree to give the lender a lien on your property as security for the loan. This provides assurance to the lender that they have a legal claim in case of default. Finally, involuntary liens are imposed on a property without the owner's consent. These typically arise from a debt or obligation that hasn't been paid. Examples include judgment liens from lawsuits and mechanics liens for unpaid construction work. These liens protect the rights of creditors when a debtor fails to meet their financial obligations. Liens can also be categorized as specific or general, a distinction that clarifies the extent of the claim on a property. This categorization is essential in determining which creditors have the first right to collect on a debt. Specific liens are attached only to a particular piece of property. For instance, a mortgage is a specific lien because it's tied to the house being financed. Similarly, a property tax lien affects only the specific property for which taxes are owed. This localized nature provides clarity on the asset tied to the debt. General liens, on the other hand, can be attached to any and all assets owned by a debtor, including real estate. A judgment lien, for example, could allow the creditor to go after any property owned by the individual or entity that owes them money. This broader scope makes them potentially more impactful for the debtor. When multiple liens exist on a property, the order in which they are paid off is determined by lien priority. The general rule is first in time, first in right. This means the lien recorded first gets paid first, regardless of the amount. However, there are exceptions, notably with property tax liens. Property taxes are a crucial aspect of real estate ownership and play a significant role in lien priority. These taxes, often based on the assessed value of the property, fund local services like schools and infrastructure. Understanding how property taxes translate into liens is vital for any property owner. When property taxes go unpaid, they become a lien against the property, typically taking priority over all other liens. This means in case of foreclosure, property tax liens are paid off first, even before a mortgage. This underscores the importance of staying current on property tax payments. Beyond property taxes, other liens can significantly impact real estate transactions. A vendor's lien, for example, is a seller's claim on a property for unpaid purchase money, often used in seller financing situations. A lis pendens, on the other hand, is a notice of pending litigation related to a property, warning potential buyers of potential claims. Understanding these various liens, their priority and their implications is paramount for anyone involved in real estate. Whether you're buying, selling, or investing, knowledge of liens is essential for making informed decisions and protecting your investment. Alright folks, that wraps up our dive into real estate taxes and liens. You've now learned about the different types of liens, from voluntary to involuntary, and how lien priority works. Understanding these concepts is crucial, not just for passing your real estate exam, but also for navigating the world of real estate transactions in real life. Remember, Ad valorem tax liens often take priority over other liens, and statutory liens are automatically placed by law, so always pay attention to which liens affect a property before making any decisions. If you found this video helpful, don't forget to hit the like button. Also, make sure to subscribe for more helpful breakdowns on other real estate topics you'll need for your exam and beyond. And remember, the key to mastering this material is consistent study and practice. So keep reviewing, stay focused, and you'll be ready to tackle that exam with confidence. Thanks for watching, and I'll see you in the next video.